Right now, there's a private club in New York with a waiting list of over 111,000 people. Not customers, not applicants for a job. People who simply want to be allowed to pay this company money every single year, and even that isn't guaranteed to get them in. That company is Soho House. And here's the part almost nobody talks about. With all that demand, with a wait list longer than the population of some small cities, Soho House lost $163 million last year alone, a business so exclusive that six-figure applicants get turned away at the door, somehow still bleeding money at a scale most failing companies would find embarrassing. So today, we're opening the books on the private members club industry, how the economics actually work, why exclusivity itself is a product, and why the most famous name in the entire business can't turn a profit even while turning people away by the tens of thousands. Let's start with what it actually costs to get in, because the range here is enormous, and each tier reveals something different about how this business works. At the smallest end, you don't even need a real estate footprint. In 2026, a New York real estate investor quietly opened a private club on the third floor above his own Korean steakhouse. Just a poker room, a few lockers for members' private bottles, and a strict invite-only guest list. No public initiation fee, no waitlist app. Just $20,000 a year, paid by a couple dozen guys who wanted somewhere private to play cards. That's the entire business. Minimal overhead, a handful of members, real profit from day one. One tier up, in the same city, you get the boutique clubs everyone's actually heard of. Zero Bond and Casa Cipriani both price membership by age. Younger members pay less to get in the door and build the room's energy. Older members subsidize it. At Zero Bond, that means as little as $750 to join if you're under 28, scaling up to $5,000 if you're over 45, plus annual dues in the $2,000 to $4,000 range depending on your tier. Casa Cipriani runs almost identically. A couple $1,000s to join, another few thousand a year to stay. Keep climbing, and the numbers stop being about affordability and start being about pure gatekeeping. The Core Club in Manhattan is famous for a specific kind of rejection. Reportedly, showing up with $100,000 in hand is still no guarantee you get in. Amman, New York takes the same idea even further with actual public numbers. A $200,000 initiation fee plus $15,000 a year just to keep your membership active. And then, at the very top of the pyramid in terms of sheer scale, there's Soho House. Not one club, but a global platform of houses across dozens of cities, with over 260,000 paying members worldwide. Membership itself generated $418 million in revenue in a single year. This is the tier where a private club stops being a private club and starts being a publicly traded company. Soho House trades on the New York Stock Exchange, the same exchange as Google and Coca-Cola. 4 completely different businesses, 4 completely different price tags, all technically selling the exact same thing. The right to be let in somewhere. Other people can't go. So how does a private club actually make money once someone's paid to get in the door? The first and most obvious engine is recurring membership revenue itself. That annual due, paid whether or not you ever set foot in the building that year. This is the closest thing to a subscription business hidden inside a hospitality company, and it's exactly why Soho House's membership revenue has been growing faster than almost any other part of the business, up over 17% in a single year, even as other revenue lines stayed flat. The second engine is what the industry calls in-house revenue: food, drinks, and event space, sold at a significant markup specifically because members have nowhere else to go once they're inside. You can't easily leave a Soho House and go find a cheaper cocktail across the street and still be at Soho House. That captive audience is worth real money. In-house revenue for Soho House alone topped $480 million in a recent year. The third engine, and the one most people never think about, is retail and lifestyle extension. Soho House sells furniture and home goods under a brand called Soho Home. It's the same playbook as a fashion label selling perfume. The actual club membership is the aspirational front door, and the real volume comes from products people can buy without ever getting past a waitlist. The fourth engine is real estate itself. Every physical clubhouse is also, quietly, a real estate asset. A building in a prime location that appreciates, that can be leveraged, that carries value completely separate from whether the club inside it is profitable in any given quarter. Stack all four of those together: recurring dues, captive in-house spending, retail extension, and real estate. And you'd expect this to be one of the more reliably profitable business models in hospitality, which makes what actually happens next even stranger. Before we get to where the money goes wrong, it's worth understanding the one ingredient that makes this entire industry function in the first place. Exclusivity isn't a side effect of these clubs. It's manufactured, deliberately, as the core product. Start with the waitlist itself. A waitlist of 111,000 people isn't just a sign of popularity. It's a marketing asset. Every month someone waits and doesn't get in, the eventual acceptance becomes more valuable in their own mind and more likely to be mentioned to friends, which creates more demand, which lengthens the waitlist further. It's a self-reinforcing loop that costs the club almost nothing to maintain. Then there's the vetting process itself, which at clubs like Casa Cipriani is explicitly built around curating the right kind of member. Not simply the wealthiest applicants, but a specific mix of finance, entertainment, and creative industry faces that makes the room feel interesting rather than just expensive. Rejecting money is, counterintuitively, part of the value proposition. It signals that the club can't be bought, only earned. No photo policies at clubs like Zero Bond serve the same underlying function. By explicitly banning photography inside, the club manufactures scarcity of a different kind. You can't simply see what's inside from Instagram. You have to actually be there, which makes membership the only way to access even the visual experience of the space. And age-tiered pricing, which shows up again and again across nearly every club we've mentioned, is really a deliberate subsidy structure. Younger members are recruited cheaply specifically because they bring energy, relevance, and future spending potential, while older, wealthier members pay significantly more to be in a room that still feels young and current. There's one more mechanism worth understanding, because it's the quietest and arguably the most effective: the referral requirement. At most clubs in this tier, you cannot simply apply as a stranger off the street with a credit card. You need a current member to vouch for you, sometimes two. This does something subtle but powerful to the economics. It turns every existing member into an unpaid, highly motivated salesperson for the brand, because bringing in interesting new members directly improves the value of their own membership. Casa Cipriani and Zero Bond both lean on this heavily. Even the New York Post's own, reporting on the city's most exclusive rooms, notes that a well-connected referral is treated as more valuable than money itself. The club isn't just selling access, it's outsourcing its entire marketing department to the people who already paid to get in. None of this is accidental. It's a business model where the product being sold isn't really the physical space at all. It's the feeling of having been chosen. So if exclusivity is this well-engineered, and the revenue engines are this diversified, how does the biggest name in the business end up losing over $100 million 2 years running? The first issue is scale itself. Soho House's losses have been driven significantly by non-cash charges, foreign exchange losses, and impairment charges tied to specific underperforming locations, including a significant write-down related to its Soho Works co-working spaces in North America. That specific division was Soho House's attempt to extend the membership model into shared office space, riding the same wave that made WeWork briefly one of the most valuable startups in the world. When that broader co-working market cooled off, Soho Works became one of the clearest examples of expansion outpacing demand. A real, physical cost showing up directly in the company's impairment charges years after the leases were signed. Expanding into dozens of cities means exposure to dozens of different currencies and real estate markets, and when several of them move against you in the same year, the paper losses stack up fast, even while the core membership business is healthy. The second issue is the tension between exclusivity and growth. The entire appeal of these clubs rests on scarcity, but a publicly traded company has shareholders who want growth, which means opening new locations, which means adding more members, which slowly, inevitably, works against the exact scarcity that made the brand desirable in the first place. Longtime Soho House members have voiced exactly this complaint for years. The club that was famous for being hard to get into now has houses in dozens of cities and 250,000 members worldwide. The third issue is that hospitality is operationally brutal at any scale. Running dozens of physical locations means dozens of leases, dozens of staffs, and dozens of local markets that can underperform independently of how good the brand is. A single softly performing city can drag down results even while membership demand globally keeps climbing. Here's the important distinction, though. Adjusted EBITDA, essentially the profitability of the actual day-to-day operations, stripped of those one-time accounting charges, has been solidly positive and growing, topping $130 million in a recent year. The eye-popping net loss headline and the underlying operational health of the business are, in this specific case, two very different stories. It's worth pausing on why that distinction matters so much here specifically. A net loss headline is what gets picked up by news outlets and repeated in comment sections. The world's most exclusive club chain is bleeding money makes for a much punchier story than a hospitality company had a rough year of currency translation. But adjusted EBITDAs is closer to what an actual buyer or operator would look at if they were deciding whether the business itself, the day-to-day version of people paying dues and buying drinks, is healthy. In Soho House's case, those two numbers have been telling almost opposite stories for several years running. A headline loss in the hundreds of millions, sitting right next to genuinely growing, genuinely positive core profitability. So here's the resolution to the paradox we opened with. Soho House isn't secretly a bad business. It's a genuinely profitable operating model wrapped inside an accounting picture that looks much worse than the reality, largely because of currency swings and write-downs on a handful of specific locations, not because members are staying away or the core idea has failed. The smaller clubs in our earlier tiers prove the underlying model works perfectly well at a modest scale. A $20,000 a year poker room above a restaurant or a boutique club with a few thousand members can be cash flow positive almost immediately, precisely because they aren't juggling currency exposure across a dozen countries or carrying the overhead of a publicly traded structure. The lesson isn't that exclusive clubs are secretly unprofitable. It's that the same manufactured scarcity that makes a small club effortlessly profitable becomes exponentially harder to protect the bigger and more public the business gets. Soho House has, in a real sense, outgrown its own advantage. Too large and too public now to stay simple, and not yet efficient enough at global scale to make the accounting fully match the actual demand. Let's put real figures side by side, the way we always do. Scenario 1. The Boutique Club. Take a zero bond or Casa Cipriani style operation. A single location, a few thousand members, average dues landing somewhere around $3,000 a year per member. At even a modest 2,000 members, that's $6 million a year in membership revenue alone, before a single dollar is spent at the bar. With one clubhouse's worth of overhead, rent, staff, utilities, a boutique club like this can plausibly clear 7 figures in annual profit once it's past its first year or two of build-out costs. Scenario 2. The Global Platform. Soho House, at over 260,000 members and $418 million in membership revenue alone, plus another few hundred million in in-house and retail revenue, is operating at a completely different order of magnitude, north of $1.2 billion in total annual revenue. And yet, after non-cash charges, the company reported a net loss north of $160 million in its most recent fiscal year, even while adjusted EBITDA, the actual operating profitability, stayed solidly positive at over $130 million. Same underlying business model, same 4 revenue engines, and 2 completely different outcomes on the bottom line, purely because of scale, currency exposure, and the accounting weight of expansion. The private members club industry sells exactly one thing, no matter which tier you're looking at: the feeling of being let in somewhere everyone else is kept out of. At a small scale, that feeling is cheap to manufacture and easy to turn into pure profit. At a global, publicly traded scale, the same manufactured scarcity becomes a genuinely difficult balancing act between growth and exclusivity, one that even the most recognizable name in the business is still visibly working out in real time. Next time you hear about a club with a 100,000-person waitlist, remember, the length of that list tells you almost nothing about whether the company behind it is actually making money. Sometimes the hardest door in the world to get through is attached to a business quietly losing millions behind it. Fundumentary breaks down the businesses everyone's heard of, but almost nobody actually understands. Subscribe if you want more of these. I'll see you in the next one. See you in